Investors and organisations gathered in the House of Literature in Oslo, Norway, to discuss whether a carbon bubble exists in the financial market, how it affects investors, and if so, how is it to be addressed. James Leeton from Carbon Tracker was the first speaker to take the floor.
Obviously there's a question around how you allocate the sort of carbon budget between different fossil fuels. So if I was an investor, I'd be more worried about the 84% that can't continue and has to be idled or retired early, because that's where the impact's going to be. I think we can see that in a short-term financial model, you're not going to pick up these long-term trends very well. You know, the market is very short-term. But what we do see is that we've already seen the decline of many coal companies. So the pure US coal mining companies have lost, 3/4 of their value in the last few years. So, we want investors to be ahead of that curve and not be taken down with that kind of decline in value. And if they're using predictions that are based on historical performance, then they're not going to pick that up. So this is why we're raising it as a kind of preventative measure, if you like, that if you're not looking out for these issues, then you could get caught with the downward trend.
To be honest, I think, at least if you look at Norway, I think it's more like a trend they want to be part of.
2 years ago, I would say no, there's no carbon bubble at all. But after the last 2 years, have changed my mind. I think that the view on the carbon market is changing. How the carbon could affect basically the investor environment. And where do I see the changes? I see the changes in big countries such as China, for example. They have a problem with pollution, they need to do something. I also see changes in the consumer side, on the consumer side. They are looking for more environmental friendly products. We also see on the investor side, they're looking much more into detail of the greener elements. How is the focus on the companies they're investing in, especially focusing on climate. So I think we have seen the change, and this trend will continue.
So I want to talk about a little bit about the kind of investment analysis of this problem and how it's moved on in the last year or so. I don't think at the moment there is a carbon bubble. I don't think that oil and gas share prices are radically out of line with their fundamental value. And for coal companies, the share prices have fallen by 3/4 in the last 2 years. So it's quite hard to argue that there's a bubble for coal. It's a bubble that has deflated if there was a bubble at all. So at the moment, I don't think there is a carbon bubble in a financial sense.
I think they're under pressure anyway on where they're spending money and how to reduce costs. So certainly, unless there's a further increase in the oil price, then they're going to have to move and show how they're focusing on value. And that's the role of investors, to really push them to demonstrate that they're focusing on value, not volume. So we really want them to look at where companies are on that cost curve and understand whether they're comfortable with that position. And if they're not, then they can either try and move those companies and get them to dismiss some of the high cost projects, or they can avoid some of the high companies that are really betting the whole business model on the high end. So yeah, doing that kind of review of where their interests sit is what we want them to focus on.
Do you see a willingness within the companies, the oil companies, to adjust and adapt to this change?
So far, I don't think so, really. It seems like they're pushing the problem ahead of them. It doesn't seem like they really reflect on it, and which is a bit scary as well, because as an investor, for example, you need to focus on the company's risk mandate, for example, how they evaluate risk going forward. And if the oil and gas companies or coal companies do not reflect in their future developments even the risk that it might be a carbon bubble, then I think they will have a problem, and I think that could be scary for the investors as well.
I think the interesting question is whether there might be a carbon bubble in the future. So if people carry on valuing oil companies as if oil will never be reduced in demand, a bubble may well develop in 10 years, 15 years, 20 years time. So it's very important for long-term investors to be thinking about those kind of risks today and ensuring that they understand how future climate policies might lead to significant reductions in demand for oil, and how that might then reduce share prices, and then there will be no bubble in the future and no danger to investors.
So yeah, I'll probably just leave it there, and we can discuss more later on the panel. It's not acceptable anymore to do nothing. You know, climate change is happening, so either we've got to mitigate it and have an energy transition, or we're going to have huge impacts. So doing nothing is no longer an option, because the future is going to be different to the past. And that's why I think it's become more of a public debate, is because people want answers about how, you know, funds are managing that risk, and if they can't articulate that, then people worry that it's not being managed.
I do think that we're moving in the right direction now, and the most important thing is really not that if we have a carbon bubble or not, because we don't know that before the bubble is actually bursted. But I think it's more important that we actually focus on how to avoid a carbon bubble, and that is what the market should focus on going forward.